Good morning, ladies and gentlemen. Well, there's absolutely nothing to see in the risk dial. It's still firmly in the buy assets and nothing new really. To me, it's significant that we are getting such a nice within all the normal parameters of a bull market in equities, i.e., absolutely nothing to see. Even the volatilities, they're not rising. There are no warning signs at all of any impending doom, quite the reverse, actually. Let's concentrate on what the QRA might do and how that picture might change and what the signs would be that it will change over the short term. Let's try and figure out what the QRA might say. We know more or less that the deficit for 2024 is going to be at least $1.8 trillion. It could be significantly higher, but it's definitely unlikely to be lower. And we also know that Q2 has the lowest financing need because of the tax income they get in late April. What assumptions do we need to make to try and guess what the figures are going to be? One is that the TGA will remain stable. That's their current account, and they don't draw down the current account, and that would be irresponsible if they did so. Plus, I really don't see any need for them to do that. The financing need for quarter two, which they announce on Monday afternoon, could be anything between 200 to 500 billion. I suppose that anything over 300 billion financing need for Q2 will be bearish coupons. Naturally, this is subject to the mix, but unless she goes for a ridiculous mix of bills over coupons, anything over 300 billion, the market will assume that even with a high bills ratio, that the coupons will be increased by at least 50 billion, and therefore the market will guess that it's bearish coupons and really sell all assets, including equities, but much less equities, much more that will sell the longer end of the coupon curve. So anything 10s and 30s, basically. Then on Wednesday, we get a new format, most probably, because they will be including, most probably again, they will be including treasury buybacks. These buybacks are completely neutral to the market because all they're doing, or what they will be trying to do, is buy off the runs and issue more on the runs. So they will be buying something with 9 years and 8 months to maturity and issuing something with 10 years to maturity. Completely market neutral, but what it does, it tightens the spreads between off the runs and on the runs, and I guess potentially saves some money for the US taxpayer. But what it does not do, it does not move the curve. It tightens the spreads. It doesn't move anything else. So completely ignore it for market purposes. So now we get to the bill coupons mix. And because of this new kink, anything over 1.1 billion in gross issuance headline, which will then break down, should equate to something like 400 billion plus in net coupon issuance. Net coupon issuance in Q1 for Q1 was 348. Anything around 348, 350, 360, 370 is not going to be particularly bearish. It's certainly not bullish because we're getting more coupons on top of record coupons. But anything over 400 billion in net coupons is going to be quite heavy. and therefore the market should care. And now let's have a look at why they might do that. So here we have a chart of term premium, and I'm really very tired of these stupid discussions that people have on social media whether supply increases or not the yield of assets. Of course it does, because what it does is move the term premium. So this is August the 1st of 2023 when they announced the large increase in coupons. And what did term Premia do? Well, they expanded by approximately 50 basis points. They went from here to here, right? So an expansion of 50 basis points. And this is when they announced that they were increasing bills and reducing coupons, or not increasing coupons as much. What did the market do? Well, it fell back the 50 basis points that it had taken out. Since then, anticipating an increase in this QRA, we've given back some, but we're still very neutral in terms of term premia. Term premia are still negative. Therefore, if Yellen is a prudent manager, she will slightly increase these coupons, right? Because why wouldn't she? Term premium is negative. So the market is paying her to increase coupons slightly. And if she does, this will go back up to around here. And I don't anticipate it to go much higher than this, because everybody now is looking at this and everybody is front running her. If she does not increase it, I expect this front running to be unwound and to be back down here in terms of term premia. But again, she would have been doing the US a disservice. Why keep term premia negative when we all know that she needs to issue? She's just postponing it to a different time, i.e. the next QRA, when the market might again have taken term premia higher, front-running that issuance. So it makes no sense to me that she wouldn't slightly increase the net coupons, and she should, because the term premia are telling her that it pays her to do so. So I would expect her to increase because it's the right thing to do. So on to the market reaction. Well, the market reaction should be seen almost entirely in the shape of the curve. The twos and the threes are going to be completely dictated by the Fed's monetary policy, and a tiny little bit by the amount of issuance that is decided in those tenures. All the effect of an increase in coupons should be felt between 5s and 30s. 2s and 3s I expect to remain stable. Let's have a look at the 2s and 3s, because those are determined by the Fed's dot plots. I naturally expect 2s to be trading up here rather than down here on an increase, but I think the move here is going to be very, very muted. 2s and 3s are just not going to go anywhere, I don't think. I think they're going to remain in this range, whatever the QRA. Naturally, I mean, if it's ridiculously high, they will, in sympathy, for a few days come back up to this kind of level. But it's all going to be in the curve. And the curve is what you will be watching. You'll be watching 2s 10s, 2s 30s, 5s 30s. If the QRA is light and we don't get an increase, I would naturally expect the 10s to actually rally, and we will be trading up here in the 2s 10s. We'll unwind this, and this has been, you know, if you compare what this is exactly that contraction, that increase in term premia that I showed you in the previous segment. This would be unwound as term premia come back down negative 25, 30. So we go back up to 47. But if we do get a significant increase in coupons, I expect the 2s10s to take 90% of the strain. And you can see if we move out how significant that's going to be. That's basically going to leave all that up there, and we will be looking for down here. We'll be looking for minus 20. So we're looking for 30 to 40 basis points of steepening on the back of a high coupon issuance. 5s30s, we will be looking for less, but still we'll be looking for this kind of area. We'll be looking for 55 from 30, so 20 to 25 basis points to the downside. The curve should take 90% of the strain, and that is what you're looking to trade. If coupons are high, the German curve will react the same way as the US curve, as swaps will basically keep the tightness between the same kind of duration. The curve will actually steepen. So this is 2s30s. I expect 2s30s to come down quite considerably, and probably down to minus 13 from plus 12. So that's, 25 basis points. You're looking to do basically in the German curve exactly the same as in the US curve. This should steepen quite aggressively. 2s and 5s are going to remain fairly stable, and as you can see, there's absolutely no reason to hit the shats on the back of it, and the bubble really is going to remain in its range, after the initial reaction, which might be to 35 or something. I think you buy the bubble here and you sell the US. You either sell 5s in the US or you sell 10s in the US, and you look for a steeper curve. But certainly the differential between Germany and the US should start going out, with the yield curve in both steepening. And here are a couple more interesting trades for your blotter, something for you to look at. This is the Schatz against the 10-year note. So DE 2-year against the 10-year in the US. This kind of level would be my favorite, down to minus 188, or 185, let's call it. So there's 35 basis points there where it could go back down to 35 basis points of differential via steepening. And 5s10s, I really would not be surprised to see these levels again. This would look like a good level, and that is minus 215 from 195. That's 20 basis points. This one, of course, is a much safer one than the 2s10s, but the 2s10s really should be the ones that make the most sense. This is the kind of move that I would expect, that people will be going into the parts of the curve which are the most sensitive to monetary policy as opposed to fiscal policy via the higher issuance from the Treasury, and therefore 2s10s, 5s10s, Germany, US are the ones that make most sense to me, naturally subject to the high coupon issuance and that mix we get on Wednesday morning. Now, it's quite interesting that the Dixie is actually a mirror image of the term Premia, expansion and contraction in the US. So here we have August and then back down. It would make sense that if we get a high coupon issuance, it will be reflected in the DXY, and the DXY is likely to go to at least this 105 to 107 area. So if you have a look at the weeklies, you're looking for a strong move next week, depending naturally on this event happening, to at least, I would have thought, this 105.67, and that kind of area should be enough, unless the coupon issuance is ridiculous, of course. But it would have to be net coupons of about 425 to 450, which would really have an effect on term premia, and term premia would probably go back up to 25.35 positive, in which case you will get a very strong move up to around these levels, around this 106.25 area. So don't be surprised if you do see a high coupon issuance that the dollar goes bid. If that does happen, gold is going to be one of the assets which is really hardest hit, because real rates will be going higher. There would be absolutely no reason to hold gold. So let's examine the mechanism. The term premia expands. Inflation is unchanged, right? So that makes real rates go higher, and tips would be favored over gold because you get a 2% real yield, you get more restriction of policy. Therefore, inflation is unlikely to go up, and yet tips are going down in price, and tips should go down in price less than gold does. Therefore, the asset that gets hit hardest would be the one that's not yielding you anything, and that would be gold. And then I would really expect gold to come down. Plus, don't forget that on top of that, the dollar's going up. Gold gets really hit, and I would not be surprised at all to see 1936 next week. That kind of level. Certainly 1960. I mean, it should really get hit hard. Buy some puts in gold. I think it could easily get to 1958, and if the QRA is very bad, 1881 is almost a given. So just let's examine that for you. If the curve steepens via the 10s and 30s going higher, and the 2s staying constant, because, as I've said, they are dictated by monetary policy, which hasn't changed, then what you are getting is an increase in real yields. Okay, inflation hasn't changed, nominal prices of bonds have gone down, therefore the yield's gone up, therefore real rates are higher. That is restrictive policy. Higher real rates, tips should definitely be favored over gold, because tips will come back at some stage, and gold is unlikely to yield you anything. Gold will definitely break this 174, and I would guess it's going to fall down to here. I think the asset most at risk from a high coupon QRA is gold. And also what I think is likely to happen is this ratio of GLD to DBC is likely to come back down to the long-term moving average here, 776. So, that is a big move in percentage terms. And I think that is more likely than not to happen. It makes perfect sense to me that should happen. Oil will remain oil and will be trading, 75 to 85, and DBC will be coming back towards its moving averages here. DBC now seems to be supported, and gold actually collapses relative to DBC and relative to itself. So if you see a high QRA, the first asset you hit is gold. We are about to close the monthly candle, so let's have a look at this. As you know, to me, it's very, very unlikely that we don't get a retracement in SPX at some stage, but within still a bull market. These are the 3 months of high coupon issuance and term Premia expansion. As you can see, it has its effects on equities. It's a dampening effect. It's not a recession-inducing effect. It just takes real rates higher, and therefore, as real rates go higher, the stock market has got less room to expand. Works via the multiple. So if that happens again, and again, we wait for Wednesday and find out, I would expect much the same kind of reaction. And where is the market likely to go to? Well, it's likely to go to this moving average, which is going to be somewhere around there, and that's going to be somewhere just below 4,700, i.e. go and retest the lows of this month. That's the kind of behavior which would be completely normal, would not put it in any kind of a bear market, would put it into a holding pattern for a while, waiting for this supply to be digested and over time again to go higher. But this is why I think that being long up here through the monthly Bollingers, which are hardly ever not retested, is, well, foolhardy. It's not foolhardy if you need to have the position, but it's foolhardy to not have it in options as opposed to have it in outrights. If you must be long, volatility is cheap, puts are cheap, hedge it. It's as simple as that. So another market which is very interesting to me is SPY over FEZ. So it's the SPY naturally over the stocks, the European equities, all in constant dollar terms. Again, if the yield curve moves the way I described, the differentials move the way I described, the dollar moves up, makes European equities more interesting relative to US equities, you would expect this to come down to these levels around the 920 area again. And that's basically what I would guess would also happen. So now let's have a look at how the stocks looks and why this might be actually a very good trade if you wanted to get some protection. What this says is if you don't want to get rid of equities, why not put less money in the US and more into Europe? Because the hit to European equities should be far less than the hit to US equities. And here we have a very long-term monthly chart of the stocks. It's breaking higher, and it's finally breaking the highs from '08. I know that this monthly candle hasn't closed yet, but assuming we do close it above this 45.79, I think impetus alone should carry it to 48.49. What would that tell me? How would that triangulate? It would basically triangulate with a QRA which is not ridiculous. Okay, so the coupon issuance is not all that ridiculously high, but Yellen recognizes that she does need to shift some of the huge increase in bills towards coupons. She issues something like 400 billion. The curve, the US curve, does steepen, probably bear steepen, as the 2-year does nothing because it's controlled by the monetary policy. And yes, I'm perfectly aware that I haven't said a word about FOMC, but that's because I expect FOMC to be a non-event. What can they possibly say? I don't think they're going to particularly push back against anything. So I've got not a lot to say about the FOMC. So back to equities. That bear steepening of the curve, what does it do? Well, it puts the kibosh on NQ going too far up, unless earnings are ridiculously good, because we're already anticipating very good earnings. And let's say we get those earnings, but the term premia expand, that compresses NQ. That in turn compresses everything else in the US. So we might, instead of getting a, 6-7% move down in the US, we only get a 3% move down in US in sympathy with the bond market. And that, after a while, after a month or so, is erased. And so equities in the US have gone nowhere net over the course of a couple of months, while Europe goes up another 2, 3, 4%. What do you get? You get the expansion in stocks back up to this 48.50 area, and you get the previous chart that I showed you of the stocks versus the US, i.e. SPY, FEZ, going down to somewhere around 970 to 940. To me, if you see a high coupon issuance, anything over, 375 net coupons, and then it might even be over 400, you know that the term premia in the US are going to expand more than anywhere else, and therefore the trades are, you know what the trades are. US equities are going to go up least. Equities in Europe should go up more or down less, and that is one trade. The other trade is the differential in the curve, i.e. all the curves should steepen, and really Germany should steepen less, but it will still steepen, so you buy shats and you sell 10-year notes in the US. I think it's going to be as simple as that next week, and all makes sense. And just a quick word about NDX and the people who think that the AI mania isn't going to slow down NDX even if term premia expand. Well, this is the history of it, okay? This is what happened during the term premia expansion phase. The 3 months of the QRA before the last, when we had this, and we started here, right here, is a period of basically sideways to down. So it does affect it. And I really would not expect this market to continue to go up just because of some AI madness. And while we get the QRA, term premia expansion, what would I expect it to do? Well, I would expect it to retest these levels, right? Anywhere between 15.9 and this level 16.3. I would expect it over the course of 2-3 weeks to come back down here, stabilize, and then go again over time. So, there is no getting around it. Term premia expansion, if it happens and it goes back into positive territory, is at best going to hold back equities, and at worst make them go down 4, 5, 6%. Okay, so those are the odds that we are playing with. Naturally, it all depends whether we get the term premium expansion, and that will only happen if we get the high coupon issuance. But at some stage, we're going to get the high coupon issuance, because if she postpones it again to Q3, then she's just postponing it. We're still going to get it because the deficit isn't coming down. So I think the sensible thing for her to do now would be to increase the coupons slightly, 10% or so. And therefore, I do believe that the odds favor that we get the reactions that I have been describing. I've changed the levels, but it's not going to mean a lot until and unless we know what the QRA is. Again, I haven't mentioned the FOMC because I think it's going to be a complete non-event. I've left here for you my QRA levels, and you know the trades. The trades are basically, if the QRA is high, you hedge some equities either before or after. You expect term premia to expand by another 25, 30, 40 basis points. If that happens, you know the reactions. Yield curves steepen, and they steepen more in the US than anywhere else. That makes real rates go up. That hits gold more than commodities. And what does it do to equities? Well, it's not helpful. It's a headwind. And therefore you go where the headwind is least strong, which should be in Europe. Thank you very much indeed. And of course, I'll tweet to you on Monday exactly what I'm doing as soon as I've seen the levels. And on Wednesday at 8:30, when we get the QRA breakdown, I will tweet to you the exact composition of bills against coupons. And then we know precisely what to do. Have a great weekend.